You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 18th of August, 2024, and I'm joined by our special guest, James Cole. James, firstly, thank you very much for coming on the show. Before we sort of dive into your portfolio and all that fun stuff, could you just tell us a bit about yourself, who you are, what you do, and how you got interested in investing, and kind of a brief overview of your investing career to date?
Yeah, of course. So firstly, thanks for having me on the show. Keen listener, probably since I began investing almost. So a bit about me. I just trained as a chartered accountant and tax advisor. Obviously, a lot of read across to the investing and finance world. And it was only really sort of 6 months into my sort of beginning work that GameStop happened, sort of in the depths of lockdown. And that's what really piqued my interest, because that exposed me to sort of the retail trading apps, and that you didn't need sort of a stockbroker who was sort of a family friend or whatever. You sort of ring him up and put in your order for 100 shares of Lloyd's, but you could actually do it all online through your phone with relatively small sums of money. So at the start, I was pretty hopeless, but then I've gradually evolved as I've gone through, and begun investing more sort of in single stocks rather than just in ETFs. And then more recently, I've also become vegan, and I'm trying to allow that to influence my investing more, because when you go vegan, you initially think about a lot about what you eat, what you wear, things that directly impact on your life, but your investment portfolio is sort of more hidden away, but it's still quite important in that those values of trying not to contribute to animal suffering where you can avoid it, and generally, create a kinder world for animals. So that's something I'm trying now to guide my investing.
So it was GameStop that actually got you into investing in the first place. How did that actually start then? Because I'm assuming you didn't start by buying GameStop itself.
No, so I've always sort of been, I guess, a little curious in investing. I mean, when you go to university, sort of the only careers people seem to find on campus are consulting and banking. They seem to be the sexy industries. So I obviously went to a few talks around that, had no idea about what a set of financial statements was, how to read a set of accounts or any of that, and just assumed that it was these big institutions or really wealthy people. GameStop then obviously sort of opened my eyes to everyone could be doing this. And you have the apps like Robinhood. Obviously wasn't going out and then buying GameStop through Robinhood, but just that you could have like a personal account with like AJ Bell or Hargreaves, and basically, start investing in your own portfolio that way.
When you talk about sort of you being vegan influence in the investing, how strong is that influence? Is it more, for example, that there's certain stocks that you wouldn't buy because of, so for example, there's a very easy one, Cranswick, which makes sausages, I'm assuming will not be a stock that you would consider, but how far does that go? As in, like, is it just that you will avoid certain stocks, or that you're actually actively looking at stocks, for example, like Beyond Meat?
Yeah, firstly, it's easier to think about keeping stocks out. So like Cranswick, McDonald's is another big example. Some of the fashion industry where they make leather goods, sort of gambling with horse racing, pharmaceuticals as well is a bit of a minefield with the animal testing. So there's obviously that sort of sphere where it's probably uninvestable for me. Well, it is uninvestable for me. But then also, on the positive side, it's a little bit harder because there are maybe fewer companies in that sense. So obviously you've mentioned Beyond Meat. Agronomics is another one, which is sort of a collection of, it's not necessarily vegan, but sort of plant-based foods. So they've got precision fermentation, it's almost like a venture capital fund for lab cultivated meat, that kind of thing. So I'm probably less on that side at the moment because there isn't the same choice available. And I think where I'm looking to go next is starting to delve under the hood a bit more, where I own funds or investment trusts, and are there any sort of hidden elements there that I can start thinking about? Maybe should I be taking them out? Should I be investing? But it's quite a complicated area, as you can imagine. There are some organizations working in the space. There's one called FAIR, which works with institutional investors. It's definitely sort of an evolving area. At the moment, it's just trying to do it as practically as I can. So obviously avoiding Cranswick is a good place to start.
So could you talk us through your investment appraisal process then, and how you would approach looking at a new stock or potential investment, and also how that potential stock or investment is likely to come across your radar in the first place?
In terms of generating ideas, I listened to quite a lot of podcasts. FinTwit was quite good. Elon seems to have messed with the algorithm, so I seem to get less relevant things there nowadays. Reddit can also be quite helpful sometimes. I'll basically have like a long list of things where I'm like, oh, that's interesting. I don't tend to screen that much. So I'll go from that list. I'll have a quick check of sort of what's the market cap. Is it profitable? Does it pay a dividend? Typically, my stocks that I like tend to be small or medium caps, dividend paying, even if it's sort of a token amount. And I prefer them to be profitable, or at least there's a route to profitability. So then once it's sort of passed through those checks, I'll then start looking at sort of the last annual report is probably the place I'd begin. Can I understand the business model? And then delve into the financials more. So I tend to look at the last 2 or 3 years annual reports. If the first one is reasonable, I'll look at some relevant RNSs, and then if there's any relevant commentary on Reddit or Google or FinTwit, just to see what some other people are saying, because that'll throw in some ideas that I might not have come across. In terms of what I like to invest in, it's more of a value-oriented approach. I quite like high-yielding stocks as well. And then, there's sort of 2 elements. There's that side is more for the single stocks. And then I'll have sort of another side for more steady investment trusts or index trackers, which is more just sort of general big picture things, macroeconomic trends, that kind of thing.
It's funny you mentioned the algorithm for Twitter, or now X as it is, because I actually interviewed someone yesterday and they basically said exactly the same thing. So I just think it's interesting that, two people in 2 days have basically said the same thing. What are the best books then that you've read on the subject of investing, and do you read much generally?
I don't actually read a huge amount in terms of books on investing. I think one of the best things I have read on investing is long-term capital management, When Genius Fails, which was a bond arbitrage portfolio in the 90s, which essentially built out of one of the investment banks. No one had really thought about the strategy, but they were just investing huge amounts, heavily leveraged up in sort of bond pairs. So say the French government bonds and German government bonds drifted away from their long-term average. They'd eventually bet on that split to converge again and things like that. So it's very low margin, but highly leveraged up. So they're making huge amounts from that from a relatively small capital base. And it's quite good at showing essentially the dangers of investing and the importance of diversification and not falling into this trap of where your portfolio looks diversified. But when you sort of start to dig under the hood, things are actually pretty connected, but you don't realize it because your approach is working. So that one's quite good. Another finance book that I'd also recommend that I read is called The Smartest Guys in the Room, which is about Enron and possibly one of the biggest accounting scandals the world has ever seen. Maybe a bit less relevant to investing, but pretty interesting.
Have you read The Snowball by, I think it's Alice Schroeder, it might be?
No, I haven't actually.
So that one's very good. So it's a Buffett biography, but it's probably the best Buffett biography that I've read. And it's got because he was involved in the 90s with Solomon Bank quite heavily. So there's quite a decent sized section on that. But obviously the guy who was in charge of the bonds department at Solomon at that point was a guy called John Merriweather. But he's the one who actually then went on to set up long-term capital management. So if you did like that book, it's probably quite interesting just because he was getting up to no good at Solomon as well, actually.
Yeah, no, it's definitely one because now you mention it, Buffett does make a cameo in long-term capital management as well, because when it all sort of blew up, there were implications for wider global stability.
Yeah, because they had to do a bailout, didn't they, essentially, to stop the whole system going down.
They wanted to tap Warren up for some of his cash, and he walked away.
Yeah, I think he made the right decision. So who do you look up to as an investor?
Yes, I think obviously the big one is Warren Buffett and Charlie Munger. I know it's quite cliche, but I think when you look at their track records, to have that sort of performance, they must have had something about them. And I think generally, when I'm looking for sort of investors to listen to, having these names that have been around the block through having some skills, and I think Buffett as well is just an education in investing in terms of his comments around things like invest in businesses you can understand, and sort of the two rules of don't lose money and don't forget rule one. So I think he makes it quite simple in terms of understanding what's going on. I mean, there are obviously some very successful investors like Peter Lynch knocking around. They're maybe a bit trickier to follow for the average investor.
Yeah, I think with Peter Lynch, I don't think he really does anything now. I know he's obviously got the One Up on Wall Street books, but I think sort of, I don't know, since then, I'm not really aware of anything else that he's actually done.
Yeah, I mean, he had that very hot streak, or obviously had that huge period of successful performance, but
but he retired really early is the thing. So yeah, he did incredibly well for sort of 10, 15 years. Retired, wrote the One Up on Wall Street book, and I think he did a couple of others as well. And I think since then he's just been sort of enjoying retirement. But I guess there's few people like Warren Buffett who want to work all the way up to 93, or Charlie Munger who worked all the way up to 99. How have you evolved as an investor compared to when you first started?
So obviously when I started, I was sort of a complete beginner and sort of fell into that classic trap of you get seduced by the story. Maybe someone's trying to sell you like a hole in the ground in terms of these sort of mining exploration companies. And I also didn't realize wholly what was on the stock market. Again, my sort of preconceived conception was you have banks, you have the mining sector, things like that, these old industries that are on the FTSE 100. And I was sort of looking more into these industries than necessarily thinking about what I'm actually looking for in a company. So I made quite a few mistakes early on, luckily with relatively small positions. Had a lot in funds of funds at that point. So, like with the Hargreaves and AJ Bell platforms, where you sort of say, what's your risk tolerance? And then just there's a fund for that. Obviously, over time, listening to podcasts, reading sort of Shares magazine, things like that, FinTwit, and also my studies as training to be an accountant. You start learning about how do you value a company, what are some red flags. And so then I was looking more at analyzing the company from a financial perspective first, and then thinking, what's the story behind this? And then trying to amalgamate the two. I think at the moment, I've probably gone from more of a story investor to more of a numbers first. What's the value? Is this cheap? But I then need probably an area I can grow in is moving more to how does the story fit in with these financials? And then a bit like Buffett, not necessarily buying things that are just incredibly cheap, but also buying things that are maybe a little bit more expensive, but they've got a great business model behind them. I think we'll see that when we chat about some more individual stocks.
What do you think then about current valuations in the UK and in comparison as well? What do you think about valuations in the US at present?
So I think the UK does look cheap, and I don't think I'm sort of the only one to say that. It seems to be, if you look at sort of price to earnings ratios, they're historically lower than they have been in comparison to sort of the world markets or internationally. I think also as well, you can see from the number of takeover offers, takeover approaches, clearly there's value to be had, and sort of the private equity can see that. I think a lot of the UK problems, though, are potentially structural from the type of industries we have on the UK market. So like obviously the big banks, mining companies, oil and gas, that kind of thing, they're never going to command sort of premium valuations. So maybe it is just that the UK is a cheaper market structurally, potentially. But then there's also an element in the smaller and mid-cap section of the market where I feel like it's driven by liquidity rather than the actual companies themselves being no good. So whereas interest rates have gone up, you can now earn 5% in cash. There's not really a great deal of benefit necessarily to sitting in sort of a small cap fund for some investors. So they've sucked their money out, which then those fund managers have got forced redemptions. So they're going to have to sell their positions in things like UK small caps somewhat indiscriminately. So I think it's definitely a good time to be looking in the UK. That's where I'm focusing on their single stocks. The US, by contrast, feels quite choppy. But again, you've got a lot of growth stocks, really high quality companies that have got very predictable earnings year after year. So maybe they command those higher valuations, but it does feel, a bit toppy. And I think you can see that from some of the volatility on single stocks. So I mean, Starbucks, an example, they had their profit warning a couple of months ago, sort of stock drops 15, 20% on the day. And then, they announce a CEO from Chipotle is taking over, and suddenly it's 20% up on a day. And I mean, those sorts of moves don't necessarily feel the most rational. And I don't think you'd have sort of that level of concern if two profit warnings, if the valuation wasn't sort of priced to the perfection, if you will. I dread to think if Nvidia sort of misses on profits anytime soon, because I think that could cause problems if people start.
Quite a long way to drop.
Yeah, I think there's quite a lot of stocks in the US where you think if there's a profit warning, this could drop sort of 50% or something.
There is. I mean, but the thing is, some of these stocks have just been like that for years.
Yeah, I mean, they
the numbers
keep going up.
but the trees don't grow to the sky. So it's difficult with some of them. How do you think about allocation and position sizing in your portfolio?
So I think this is something that I definitely need to think about more, because I probably do run quite a bloated portfolio at the moment. So I'm trying to consolidate more. Typically, I'd say an ideal portfolio to me is maybe 20 to 25 positions. Obviously, not all of them are going to be single companies that you're having to track sort of quarter by quarter. So maybe an ideal portfolio would be 50% in indexes or like investment trusts, and then in single stocks, maybe the other 50%. At the moment, I'm probably a little bit heavier in the single stocks. It's not something that necessarily I'll be monitoring quarter by quarter. It's more sort of an annual thing. I'll write down my positions and see what's grown beyond what I'd intended it to be, and then maybe trim, and some of the smaller positions just chop them out and try and consolidate a bit more.
So what is it presently then in terms of, I know we're sort of diving into the individual portfolio a bit more, but in terms of the allocation between, say, index funds, actively managed funds, individual stocks?
So I think we're more at like a 60-40. I don't have any bonds in there currently, but I mean, that was one of the other mistakes I made when I began, was I thought bonds were a good way to go and probably went too heavy in bonds for someone at my stage in life. And obviously then interest rates just killed that. So that's potentially another element that I might look at bringing back in with interest rates falling. So maybe it's something like a 40-40-20 is what I'd aim to get to, but we're probably a bit lopsided at present.
How much time would you say you spend a month then on investing in your portfolio?
So I reckon it's probably on a weekly basis, probably easier to track. It's probably like 2 or 3 hours a week, because typically I'll read, sort of have a little check on, see what the RNSs are each morning before work. I have a little read of some of the interesting ones, maybe at lunch or later in the week. And then I'll read shares fairly religiously. So that's sort of my active reading. Probably comes to like 2 or 3 hours a week. But then equally, the beauty of podcasts is that you can just have them playing while you're in the car, or like chopping the vegetables at dinner, things like that. So it's probably more than that, but it's less active than listening. So I might be sort of dropping in and out, but you pick up quite a lot of useful tidbits that way.
What are your thoughts on Bitcoin as an investment?
So personally, I don't hold any Bitcoin. Bitcoin fundamentally for me isn't backed by anything. I don't see what value it really has beyond someone else paying for it compared to like investing in gold. And equally, sort of this digital store of wealth, I'm a bit unconvinced on as well. So like what you saw with the recent volatility, Bitcoin was dropping sort of as well as the tech stocks in harmony. There wasn't, that element of safety that you'd maybe be looking for in it. But then equally, I think there are times when there are trading opportunities around Bitcoin. So like when FTX crashed, sort of a lot of money got sucked out of crypto. That was probably a good time to pick some up for a bit. And then equally, when there was the spot ETF was getting approved by the SEC, there's probably an opportunity around there, around liquidity flowing in. But I mean, that's more a trade than a long-term hold for me.
So that's everything in terms of the more general questions then. So we'll now move on to the questions that are more specific to your actual portfolio. So firstly, why do you like Match Group as an investment?
With the US as well, you've got these sort of huge growth stocks. And then you've also got some stocks which appear to be in sort of value territory more, that were sort of priced as growth stocks during the pandemic, but are actually more value stocks now. So I think PayPal falls in that category. And then you also have Match. So essentially it owns Tinder, Hinge, basically the major dating apps other than Bumble. But these apps are now churning out a huge amount of cash. You've got sort of a reasonable price to earnings of 15. Cash flow is more like a 10 times yield. And sort of the interesting thing here is that you've also got these very reliable cash flows from things like Tinder, but you've also got Hinge growing at 30% a year. And you've got a position where it's very hard for competitors to challenge. Because if you think about setting up a dating app, no one's going to use your app unless you have people on it. But then if you don't have people on it in the first place, how do you attract more? So it's all that sort of flywheel where the bigger apps just seem to attract more people. So the business model feels quite stable, feels like people are going to keep dating. And then management doesn't need to do a huge amount in terms of maintaining the apps. A lot of the spend, the marketing, the heavy lifting has already been done. And so they've now committed to sort of 70% of free cash flow to go on share buybacks, which means that sort of they're buying back 6 to 8% of the company a year. In real terms, free cash flow looks like about $1 billion a year is what they're guiding, on a market cap of 9 billion now. So it's quite similar to PayPal, but it seems to have more of a moat, for me at least. I don't know if you've ever looked at it, but it feels like the sort of stock that, if you like PayPal, would be of interest.
I feel like we covered it once on the show a few years ago, and I think it's one of those stocks. I think it's dropped more. I think it was fairly cheap when we covered it, but I sort of got a figure in my head of like 20-25 times earnings, and I think it's done quite poorly since then. I follow a few people who themselves own it, so sort of see little bits on it. I knew it was cheap. I didn't realize it was that cheap. Just a couple of questions on it. So do you know, is there any like stock-based compensation or anything diluting those buybacks?
Yeah, so there is a bit. So that sort of 6 to 8% is with the stock-based. So I think
Oh, so that's after, or sorry, before.
Yeah, so I think, I was looking at this the other day, and I think they bought back, it's about 250 million of stock, but that was with the adjustment for stock-based compensation. It's not sort of extreme compared to some companies. So there is definitely the share count coming down.
Okay. So why is it so cheap then? Because that just sounds, I think probably more so than PayPal, in that it seems like a business that long term you would think has a lot of tailwinds in terms of the way sort of society is going, in terms of obviously like more and more people will be online dating. I think the proportion of the population that meets it will go up and up. But as well, I think sort of generally like with younger people, I think people are sort of staying single for longer. And I don't want to sort of generalize, but if I compare it to like us to like maybe my grandparents' generation, with my grandparents' generation, it did seem more like you go out with someone for a few months as a teenager and you get married and that's it. Whereas I think now people probably partly because of the internet, but I think people are a lot more aware of just how many options they have. And I think people are generally more picky, and that's probably reflected in people settling down at a later age. So in terms of demographic tailwinds, you'd think there's a lot going for it. So why has it gotten so cheap in the first place? And is there anything in there that's cause for concern?
Yes, I mean, I think the big thing that potentially has been a worry is that there is a bit of user drop off in Tinder, but then partly some of that is them cleaning up the bots. And so I think user numbers are potentially an issue, particularly as compared to the COVID period. Obviously, people only had their phones. You couldn't go out to like the bars, things like that. So I think the numbers have come off the boil a bit compared to then. But then equally, it's now reached a point where it is just so cheap, in my view. And then equally, I think there's a bit of concern potentially around sort of anti-competition because it is so dominant. I think there was sort of murmurings that it might acquire Bumble, but obviously that would never fly, was the conclusion I saw. And Bumble has also done atrociously since, so it's potentially got sucked up into a bit of that negativity. On the declining users, I think one key point is that the average spend per user is going up, and a lot of the revenue comes from a relatively small proportion of the users. I don't know the exact figure, but they were talking, there was an earnings call where they were saying basically they'd got these super users where they were paying huge amounts on the app compared to sort of like most people using just like the free version of Tinder. And equally, it's interesting you do touch on tailwinds. There's scope as well where they're an app. Obviously, a lot of that, a reasonable cut, goes straight directly to Apple and Google. But sort of with the general noise around their position, I think it's Fortnite that's challenging Apple or has challenged Apple recently, that potentially that cut of revenue comes off or comes down to a lower proportion, which then obviously just directly flows through to the bottom line and reduces cost of sales. So yeah, that's another interesting angle that I think is quite attractive.
So you've got Money Supermarket in your portfolio. So just for full disclosure, I'm slightly biased on this one because it's also in my portfolio. Why do you like it?
So I think again, it's not like a demanding valuation. Price to earnings about 15. It's got its dividend yield is pretty good, generates a lot of cash. So I think the underlying financials are pretty solid. And then equally, you've got sort of these tailwinds coming in where I think during cost of living, there's a lot of people will have turned to these price comparison websites when they might not have necessarily before, or it wouldn't have been so pressing. But once you have used it, you tend to keep using it. Equally, you've got, I think the Quidco acquisition is quite a smart one. And yeah, I think there's sort of the tailwind of the energy sector coming back in terms of switching. So that's one thing that I think the business model has shown itself to be pretty adaptable, pretty robust, in that it can lose one of these big segments and still keep going quite well from its other sectors. So yeah, I just think it's quite a solid base position to have. It's quite sticky in terms of once people have used one of them, it's got your details. So at the moment, I'm renewing car insurance and I'm getting sort of almost weekly updates from Money Supermarket that the renewal's coming up and that I need to do it. So once you've used one, you're sort of in their ecosystem, if you will.
Why do you like the Vietnam Opportunity Fund? And you've also got a Franklin India Fund as well. So what's the logic behind those two investments?
So I think they're both very much a play on demographics and sort of the wider geopolitical position. So obviously India has got a massively growing young population. It's got a growing middle class, increased consumer wealth there. So in terms of growth, that's got quite a bright future from that sense. And the same with Vietnam. There's also in terms of offshoring. I don't know if you've seen sort of a lot of American accounting, for example, that's being moved offshore to India. That's scope for professional services as well as manufacturing to go out of places. And then you've got the wider geopolitical issues with China, where I think Vietnam and India become quite big beneficiaries because they have the scope to pick up the manufacturing that has traditionally been done in China, but where now firms like Apple, for example, are getting worried about the trade wars, for example. A Donald Trump presidency would be quite negative for America-China relations. So India stands to be a beneficiary, Vietnam as well. One thing to be aware about with the Vietnam Opportunity Fund is that it's relatively expensive. It's sort of, I want to say it's 1.9% management fee, but then equally, it's very hard to get exposure to Vietnam directly. The same with India. So you sort of have to go through these slightly different fund structures.
I think the difficulty is if you do end up with an actively managed fund, that is just kind of the going rate. And I don't think, I'm not really aware of any sort of passive Vietnam funds or anything.
Yeah, I think it's only 3 for Vietnam, and this one sort of had the best performance. It's also on a 20% discount right now when it has traded at a premium before, but obviously where it's got quite a high proportion of private equity holdings. So yeah, it's sort of a bit out of vogue right now.
Why do you like Games Workshop as an investment? And again, for full disclosure, this is another one where I own it, so any confirmation bias is appreciated.
So I think Games Workshop is just a very slick business model when you look at it. It sort of owns the production to the getting it to customer through the stores, and then it owns all this IP as well that potentially could be quite big. So I mean, even if you ignore the IP for now, you've got a product where you've got sort of operating margins over 30%. You've got an incredible return on capital there, and then it's only sort of 20 odd times earnings, which in the grand scheme of things isn't expensive for the growth it's got and sort of the quality of those earnings. And I mean, yeah, as you pointed out on one of your recent episodes, the store count is quite attractive in that I do wonder if UK's almost reached saturation maybe for stores. I don't know how much more demand there is for these stores here, but the UK is relatively small compared to the US, which I guess is the holy grail for any UK company. So there's possible huge growth there. And then the same with Asia, although I guess that's less of a focus right now compared to the US. But then you tap on the IP revenues, that's almost all profit. And then equally, provided it's done well by Amazon, you've effectively got great marketing there. So you've almost got a flywheel effect in that you have this IP, it does well, you then potentially have more IP deals to create the shows. People watch the shows, they buy more of the product. So that's quite an exciting prospect in my view.
I agree with that. I think with the Asian stores, because the Asian stores I think are actually the smallest. I think they've only got something like 20. I think what I struggle with Asia is I don't know if culturally it's because it's so different culturally, it's harder to make that assumption that if you just kind of drop it in, it's gonna, it's going to do well. Whereas I think in the US, it's like, what's the kind of product you could see doing really well? And the question is just whether there's already some kind of, equivalent out there already that's sort of firmly entrenched. But culturally, you would kind of think there's that same kind of market of buyers and people that would be interested in it. But I think fortunately, it's kind of like, because it's quite reasonably priced as well, and the US count seems low. I know it's bigger than the UK, but it's a much, much bigger market. And also I think Europe seems quite low as well, which again, you'd think culturally quite similar. I think you can almost take the view of it, well, if Asia does well, that's basically just a bonus, but it doesn't have to do well for it probably to be a very, very good investment. And I think it's the same with the IP. Obviously, ideally, they'll continue monetizing the IP and that'll get bigger and bigger. But I think they can do so well off just the stores that, the Amazon series could flop. And it's like, would it really change the valuation? Because I think even if you took Amazon away, it's still pretty cheap at 20 times earnings.
Yeah, I mean, the IP revenue feels quite small at the moment. So it's sort of an added bonus, which I think I quite like these in stocks when you've got a fairly solid position to begin with and you start layering on these sort of almost like strategic options on top. They could be quite valuable, but even if they're not, then you're doing quite well.
Yeah.
And I think the other thing with Games Workshop is it's quite upfront with its reporting. So in terms of how the licensing revenue's going, how the IP deal's progressing, I feel they're quite they'd be quite forthcoming to the market. So you don't sort of need to be looking in hidden parts of the annual report. And again, with the accounting as well, even if the valuation does get a bit stretched, you can start, they're not trying to hide that effectively. The accounts are really clean, which is quite nice to see, really.
You talk about, you've got a couple of REITs in there. So you've got Supermarket REIT and Tritax. So what's the logic behind these and why do you like them?
Yeah, so I mean, I think this is partly for a bit of diversification, but equally where interest rates have gone up, these have definitely come out of fashion, because if you can get 5% in cash, why it's a lot riskier, obviously, to hold something like Tritax and get 4%. But I think there's sort of a potentially capital value there. So like they're both at reasonable discounts right now. Supermarket REIT has historically traded at a premium, but it's now at sort of a 15% discount. And when I got in, it was a 9% yield. And so when you then look at the underlying tenants, you've got very high quality of tenants in that mostly it's Tesco and Sainsbury's. I don't think they've ever defaulted on their rent or are likely to in the future. And then equally with those stores, they own a lot of the big box type units. So, you know, like the Tesco Extras, that type of store, which tends to generate a lot of revenue for these companies. But there are also relatively few sites to build new ones. So they hold quite a lot of the prime real estate in that sense. So if they ever did run into problems, say with debt, they could just sell these to like Sainsbury or Tesco, and they probably wouldn't have an issue with selling them. And then equally, sort of the big risk with rental portfolios is that your costs go up by more than the rent. But I think in this case, Tesco or Sainsbury are quite able to absorb reasonable rent increases above inflation where these stores are profitable and are sort of their main driver of growth currently. So that's partly why I like Supermarket REIT. I don't know if you've ever looked at it on the show before.
No, we tend not to cover REITs. I do like the idea of it, and I think if I were to actually look at having a REIT in my portfolio, I think Tritax for me is the one where I just look at that and I think again, sort of it's got quite a lot of tailwinds in terms of the type of properties that it's actually letting out. You would think great spots, like just off motorways, massive distribution centres. Like we looked at it the other week, 12% of the revenue comes from Amazon. And you think, well, you'd only expect that to get bigger. Even if not, you'd think there's going to be more and more businesses that are going to be wanting these kind of distribution centres because businesses do just seem to be getting bigger. You do just seem to get a lot more businesses at the bigger end that are just getting bigger and bigger and bigger. I think Supermarket REIT, we've not done it on the show, but I am aware of it, and I probably do like the idea of it. But I think the issue I've got is that I'm just not overly interested in having a REIT in my portfolio. If I were to have one, it would be Tritax. But even then, Tritax, I really like it and I like the idea of it and the properties. But I think it was like 1.9% fees or something when we looked at it the other week. And it's like, well, do I really want to be paying that? Because that's like half the dividend basically gone. The other thing is that I'd struggle with, and I know they can take on debt to help sort of mitigate this, but the fact that they can't reinvest the earnings, they have to pay it out as a dividend to maintain their REIT status. Again, I don't particularly like that either. So I think it's more that REITs in general are just not something at the moment where I'm interested. But I think when I'm older, I think if I wanted more income, it's probably something that I would seriously consider.
Yes, I think Tritax is why it's a bit of a special situation right now, because it's just had the merger with the UK Commercial Property Trust. And so it's sort of obviously there is some overlap in their sectors, but yeah, it's got some other assets as well that aren't sort of these big boxes, which I think gives quite a good opportunity now, because where some of these are quite high quality, they'll be able to recycle that capital fairly effectively, quite quickly. And then that's effectively given them more funding to then pump back into these big box units. And obviously there are some distressed sellers in the market. There's potentially some good value to be had there. I guess the one danger with that is that obviously there are going to be some less good units in the new portfolio that aren't logistics units that could be a bit trickier to sell, could hang around. So but I think that's one of the big appeals for Tritax, which I've seen as a negative. But I think being able to recycle that capital from the UK Commercial Property Trust is quite a good opportunity for it.
You've got another 17% sort of in your portfolio that when I looked at it, I was struggling to see how it was split. And it mentions PayPal in there, but doesn't include a percentage. Are those stocks that you own, or is that sort of, is that 17% cash, or what exactly is that?
So I've left off cash from sort of the portfolio I sent over. So I hold sort of an emergency fund, which basically helps me sleep at night. And then I've got sort of smaller positions, which are basically they're in a bit more, maybe a few more American focused stocks, things that I'm hoping will grow into sort of a full position for the ISA, things like that. But it's just easier because it's a low fees account. So it's easier to just drop in some cash if there's like a flash crash or something puts out a profit warning, but fundamentally is a good stock. So PayPal's one of the biggest positions in there. There's about 35 stocks and that's 17%. So it's obviously, but they're all quite small. So it doesn't matter too much if one drops down a bit because you've got the others propping it up. But they're all things which long term I could see myself owning, but it may be like...
Okay, so it's just to force you to keep an eye on it, basically.
Yeah, so I mean, like one of them, for example, is a little stock called Air Test Systems. It's 300 million market cap in the US, and it is effectively testing equipment for chips. So when I first came across it, it was on like price to earnings about 40. It's growing quite well, but it felt a little bit stretched. Earlier this year, it came out quite a nasty profit warning, dropped sort of like 30% on the day, came down to like 30. And so then obviously in this portfolio, I was able to just sort of drop in by like 100 quid's worth just to sort of get a foot in the door. Then sort of 3 months later, it dropped again. So it's another opportunity to come in because the reason it was profit warning was essentially that it was having delayed orders for electric cars, which long term I feel is quite bullish macro trend. These orders, it was more like a timing issue than these orders aren't there. And sort of the semiconductor industry is quite a lumpy industry anyway. It's sort of big contracts here and there. So that then gave me an opportunity to get in a relatively small position, but sort of quite quickly when these announcements were made. And then it's come out with its full year results relatively recently, and earnings are basically in line with what was forecast because it had huge orders in the last quarter of the year, and it's made an acquisition testing chips for data centers, which is another sort of big macro trend. And then it sort of went up like 70% in a week. So that's sort of an example of where it worked quite well. But then there are also some maybe more stodgy positions like PayPal in there, Legal and General's in there as well, that are maybe to just sort of, add a bit of ballast. But I don't really want to sit in cash with those amounts. So if something does come along, I might cycle or raid Legal and General to stick it into like CrowdStrike or something, for example.
Right, okay. So what's Burford Capital then, and why do you like that?
So Burford Capital is, I think it's quite a good one to hold because essentially it's litigation finance. So say you're a company that's got a lawsuit against another company, say, I don't know, but you've got no money to fund that claim. You'd go to Burford Capital and then they'd effectively, assuming you've got a case, they'd then fund the lawyers to basically go after the bigger company to then try and get damages or whatever. And then that cut of damages, a cut would then go to Burford Capital. So there's a big case at the moment between a telecoms operator and the Argentinian government, which effectively from what Burford Capital is owed as part of that is a big chunk of the market cap. So that alone is quite promising. Obviously, there's a risk that these companies might not pay, but sort of the situation in Argentina is that they've acknowledged they have this debt and they're willing to pay it essentially to retain credibility internationally. So that's sort of an example of it. But by its very nature, it's counter-cyclical. So these cases don't tend to be aligned to wider economic cycles. So it's quite good in that sense that it doesn't matter what everything else is doing. It's quite disconnected. It's very much specific to its cases. It generates quite a high return on these cases. And equally, it's branching out more into trying to generate these lawsuits for companies rather than companies necessarily coming to them, where it's grown to such a size that it's got a lot of cash to deploy. It's not able to necessarily deploy it all in cases where companies come to them. So it's trying to originate these cases itself and get the companies in. And it's got a very good competitive advantage in the sense that these cases, a lot of the judgments tend to get sealed, or the public might not necessarily see sort of the ins and outs of what's going on. But Burford Capital now has a lot of cases where it's got all this proprietary data, which isn't in the public domain. So when someone comes to them with a case, they can go, well, you know, it's similar to this one we've had, or this is sort of a trend in the judiciary system, you know, this has got a good chance. So in theory, it should be improving its hit rate each time, which is hard for someone else to muscle in because they don't have this data or the reputation in the sector. And it's also heavily founder-led, which is quite promising because these guys have basically built it up from scratch. So they're quite savvy operators. So yeah, it's quite a tricky one to sort of analyze from it's very difficult to assess, are the intangible assets worth what they say they are? But sort of the Argentina case alone gives quite a lot of weight behind that, and sort of their track record supports that quite well.
What's the valuation like?
I mean, it's a very hard one to value because it does pay a dividend, but it's quite a token dividend. So it's maybe like 1 or 2%. Obviously, with these cases, its earnings are quite lumpy, and a lot like the cash earnings might not necessarily relate to the book earnings because you're sort of revaluing the value of these claims. It's currently a market cap about 3 billion from memory, and this sort of Argentina judgment is sort of multiples above that. It's a bit binary in the sense of if Argentina don't pay, the investment thesis collapses. But if Argentina do pay, then you're basically getting all your money back in cash from the Argentina judgment, which has already been sort of, the judge has already declared that amount is due, and it's then basically just getting that cash out of Argentina, but it is incurring interest along the way. So there's sort of a little risk of it being eroded over time if there's delays with that cash coming in.
I think I'd be very, very cautious about an investment that was dependent on Argentina paying up, because if you look at the number of times they've gone bust, I definitely wouldn't.
So I think it's not necessarily wholly dependent on Argentina paying up. I think that one sort of, if it does happen, then the investment case is definitely correct. If it pays sort of, it has to take a haircut on that amount, it's probably okay because it's got all these other cases. And also another thing is obviously during COVID, the court system has generated quite a backlog. So there's a lot of cases which previously would have taken, say, a year, 2 years, have taken like 3-4 years. So there's the pipeline coming through is quite strong now. They're expecting to see more cash coming in sort of this year, next year from these cases that previously they would have expected to be realised over the last couple of years, but haven't been able to because of the backlogs.
What's Calnex Solutions then, and why do you like that?
So Calnex Solutions is a real tiddler, about a 50 million market cap. And essentially it makes testing software for the telecoms industry. It's also moving into testing software for data centers because there's a bit of crossover between sort of the providers for those. And it's a bit of a special situation right now in the sense that its earnings have collapsed. It's gone to break even basically because the telecom sector is suffering. But then when you look at it, it's got no debt. It's got 12 million of cash on the balance sheet, which is quite good. So it can basically operate as it is indefinitely from what it's got. But then you look at the top line and its revenue has come down sort of 50% from 2023 because of this sort of slowdown in the sector. But on that revenue, it's making margins of 75%. So effectively, it's a bet that the company is going to keep going, or it's able to survive for now. But then, say in a year or two's time, when economic conditions improve a bit, there's more investment, then it's got these huge margins that it can just generate off the same cost base. If it can get back to the income of 2023 with the cash in its balance sheet, you get to like a price to earnings about 6. So it just feels like, although it's out of fashion at the moment, it's sort of out of its control in a way. And then when market conditions improve, it's potentially going to make pretty reasonable returns. And it's then going to become quite cheap, and you start seeing the money flowing back in to Calnex, but then also in the wider small cap sector.
So where do you find all these small caps then? Because it seems like quite a lot of your portfolio is in small caps. So how do you actually get these coming across your radar in the first place?
Yeah, so I mean, a lot of these come from podcasts. So one that's very good, which, I mean, to be fair, Flying Finance, Andy, when you did the interview with him, he brought up a few of these. So there's one with Paul Scott, who writes reports for Stockopedia. He does a very good podcast, which basically summarizes a lot of the week's news, and he's focused on small caps. Same as one, Conker's Corner, which is quite good, where they'll sort of go in depth into stocks and research ideas. So it might not all be small caps, but they do bring up some of them. And probably the third one that I like is called Investors Champion, which is relatively new. They also go into detail, but one of the guys on there is a fund manager, and he runs sort of an AIM portfolio. So he's quite aware of what's going on in the lower end of the market. And I think that's quite an attractive place to fish, because partly because of my background, where I work with a lot of companies that are similar sized, it's quite understandable, the reporting. I can sort of almost envisage what's going on under the hood in some cases. And then equally, I think there's an element of domestic bias being a good thing in some ways, because you can kind of understand the product, how it's going to work in this country, or you understand like how it might look. Whereas I think sometimes looking abroad can have its pitfalls of, you don't necessarily know what a Target store is until you walk into Target, that kind of thing.
I think going back to Calnex Solutions, I think for me, what would make me uncomfortable, and it could be the best business in the world, but I think because of like how bespoke the products it's creating is, or the products it is, I just think it would go in the too hard pile, because I think when you're getting into sort of instruments for cloud computing and telecoms and stuff like that, it's so bespoke that I just am not capable of sort of looking at maybe the products and being like, well, yeah, they've got a moat with these products and I think they'll be able to keep it. So how do you feel about that, and how do you deal with that, or is that sort of dealt with via the size of the position?
Yeah, I think that's more the size. I mean, that's why it's not sort of a bigger position than it is, because obviously there is the risk that it's kind of contingent on being able to maintain its R&D spend, being able to keep providing software that's used. But then equally, there's a bit of an element of picks and shovels, in that I think this data centers segment potentially has got quite a lot of growth ahead of it. And the same with this telecom spend. Eventually, there is going to need to be capital spend to bring things up, to get 5G installed, that kind of thing. So I think that makes me a bit more comfortable that as sort of like a picks and shovels play than it's going to be the market winner necessarily.
So final question, what's One Media IP Group and why do you like that? And you've also mentioned that you've got a sort of a link company, artisanal spirits company too. So could you just talk about those two?
So I think, yeah, these are quite interesting companies that they're right at the bottom end of the spectrum. So One Media is only a 9 million market cap. Artisanal Spirits is also not a great deal bigger, but they both hold basically assets that are worth more than the market cap. So One Media has a portfolio of royalties for music, which it then, when it gets played on Spotify or it appears on a show in Netflix, then they'll get a cut of that revenue. So they had that valued a couple of years ago, sort of at closer to 35 million, made a few acquisitions since. So already you've got potentially a disconnect between the assets the company owns and the market cap. One thing, and as well, that's not reflected in the accounting because it's an intangible asset, so it can't be revalued by the company in its accounts itself. Sort of a routine screen, it wouldn't necessarily show up as having net assets significantly worth more than the value of the company. So that's ultimately the investment thesis, and that this cash will keep being generated by the royalties, and then, yeah, it will get paid out to shareholders. There are a couple of issues with One Media. Firstly is the size of it, because where it's sort of the wrong side of 50 million, it's kind of quite hard. It's a bit of a drag to maintain the listing because it's quite expensive. It's sort of £500,000 a year is the figure that's typically bandied around. So it's arguably at risk that it's possibly too small. And then it's also got a sort of software business within there, which is very unproven. And sort of before I got in, had been a bit of a drag in terms of cash resources. So it's looking like the company's investing less in it, and it effectively is like an anti-piracy app. So they potentially sell it to artists to check that their music hasn't been streamed illegally elsewhere on the internet. So that potentially is actually quite beneficial to the company itself because they're equally at risk of piracy. But it is a bit of unproven within there. So I'd quite like to see that spend being dialed down for them to then focus more on the royalty side of things. But so it could be a value trap. I'm not sure quite yet. But then equally, there's a few companies like Artisanal Spirits company essentially runs whiskey tasting events, but also owns a huge amount of whiskey. So they reckon they've got enough whiskey to keep them stocked till like 2030 or something crazy like that. And so at the moment, that's on their books at the cost value. But sort of the market valuation of that whiskey could be closer to £500 million. So obviously there's a big disconnect between the market capitalization and then that inventory on their books. The big question is, can they basically get that whiskey out to market, which so far they haven't shown any evidence that they can. If they start showing there's evidence they can start getting sales up, getting it out the door, then it potentially becomes quite an interesting investment thesis. So yeah, there are a few others as well around the bottom end of AIM, where companies have assets that are potentially worth a lot more than the market cap, but it's just whether they can realize the value from it, and is the market ever going to also recognize the value, or is it going to be stuck as a value trap? But One Media, it's quite a small position because there is quite a lot of risk there.
So I think I've got a couple of comments. I'll do one company at a time. I think One Media, have you ever looked at Hypnosis Songs Fund?
Yeah, it's a similar.
Yeah, it's just a smaller version. So Hypnosis, we've covered a couple of times, and the problem is, I know you're sort of saying, well, they think these songs might now be worth 35 million, but the problem is, how do you value a song? You've got not really any idea, unless you've got some stuff where it's certain Christmas songs are going to be played every year for the next 20 years, but then a lot of other ones, it's much harder to tell. But then as well, it's somewhere like when we looked at Hypnosis, you'd go through and there's some quite recognizable songs in there. I think one thing that sort of majorly put me off now is my girlfriend's quite a big Taylor Swift fan. I think Taylor Swift sold the rights to quite a few of her songs. I don't know whether it was to Hypnosis or like some of a similar vehicle, but I think she then had some kind of falling out with this company that she'd sold the rights to. So she just re-recorded the same songs and just, slightly different. There might have been like slightly different instruments or like, it wasn't exactly the same, but it was like basically the same lyrics and the same song. And she just called it Taylor's version and re-released it. And then that's obviously, if someone does that, then overnight the value of that song just falls off a cliff. And I can't see any sort of real legal reason why the other artists wouldn't follow that, which would just be majorly concerning. If they can just release 15 versions of the same song and sell 14 of them. And the thing is as well, like because my girlfriend is a Taylor Swift fan, she makes a point of like, she tries to listen to Taylor's version because she wants the money going to Taylor Swift. So it just sounds absolutely horrendous for someone like Hypnosis. I think at that market cap, though, the piracy app, the anti-piracy app does sound much more interesting. They could crack that. But then the issue with that is, how big a market is that? Because you'd think there's a few companies you'd sell it to. Or I guess it would be the artists that would want it more than the company. Measuring the size of that market is difficult. But that does sound potentially interesting. I don't know if you have any comments on that before I move on to the
Yeah,
spin-off one.
it's always been a bit of a checkered history of the songs funds. There was another one called Round Hill, so that one was quite successful, and then got bought out. Hypnosis, their big problem as well was there were sort of quite significant governance issues. So eventually, Round Hill got brought in to try and sort it out, their management at least, and Hypnosis sort of then got bought out. But I think their big problem as well was they bought sort of new songs. So they had like the rights to Shakira, things like that, whereas you're never really sure what the long-term popularity is necessarily. Whereas One Media, it's sort of run by a bit of a colourful character. He's a bit older. And so they focus primarily in sort of songs from like the 60s through the 90s. And then also they've got like a big classical music collection. So these songs from like the 60s to the 90s, they've got a much better idea of what does this look like over time, because sort of people have been playing them for however many years. So I guess they've got more visibility there rather than sort of like just 5 years of data and the name Shakira. And then also this classical music portfolio is a lot easier to place in things like Netflix dramas or films without you even realizing it. So I guess in those cases, there's less incentive for someone to re-release or re-record their music, because these artists are kind of gone to retire, or they own some of Take That stuff. So you're like, obviously, it's quite hard to take that back together. And then with the classical music, it's just, there's not the same, like if someone re-records, I don't know, some piano piece, it's unlikely they'd have the following for it to be worth their while, maybe. So I'm a little bit less concerned about the valuation there than something like Hypnosis. But I agree, it's pretty subjective.
Yeah, I think there's still an element of subjectivity, but yeah, that sounds a lot less concerning than what was in Hypnosis's portfolio. So if we go back to the spirits one then, when you're talking about, well, the inventory could be worth $500 million, is artisanal, I'm sure I've butchered the pronunciation, but is that the name of the brand itself? And is that the issue, that they've got all this whiskey ready to go, but basically no one knows the brand, and whether anyone wants to buy $500 million of their whiskey is actually the issue, is actually the problem?
So it's quite an interesting business model in that they own, it's called like the Scotch Whisky Club, something like that. So it's like a membership of whiskey aficionados. And they also have one now in the Far East as well. I think it's Japan or Taiwan, possibly. So I think that's one of their primary distribution routes, which I guess at the moment it's not that big. So it's kind of like one of their KPIs is tracking those active members. So that's potentially a bit of a bottleneck, if you pardon the pun, to getting the whiskey out there. But it feels as if they take this whiskey from distilleries and then effectively store it to then bottle and sell later on. So it feels like something which, if they ever did do a liquidation event, they could try and sell through the distilleries or something maybe. And I mean, it's so many multiples above the market cap that would be feasible. I mean, it's got a bit of a support to this value as well, in that they have a borrowing facility against the value of the whiskey, and the people who value that and lend based on it, they've basically just upped the credit line. So even though they're not using all that to borrow against, it sort of gives some credence to the claims that they're making.
So I think that's everything on my list. Is there anything else you'd like to discuss before we wrap it up? And if not, where can people find you if they do want to follow you or learn a bit more about you?
No, it's just to say a massive thank you for having me on and having a bit of a chat. And if anyone does want to find more about me, just follow me at Bishop Bandit on Twitter. I'm not the most active, but yeah, if anyone has any questions, feel free to DM me.
Is it at OG Bishop Bandit?
Oh yeah, sorry. Yeah, no, it is. Yeah.
That's fine. I wasn't sure if I jotted it down wrong. Where did that name come from?
So yeah, it's basically my chess.com username. So it's emerged from that. It wasn't originally a ThinTwit thing. It's just sort of evolved since then into a mishmash of things.
Right. Well, thank you very much for your time and for coming on the show.
Thanks for having me once again.
And I think that's everything in that case. So thank you very much for listening, and we'll see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.